You turn the key and the engine catches, sending a rush of warm air through the vents to fight off the morning chill. But as you wrap your hands around the steering wheel, what you feel is not excitement for the road ahead. It is a heavy sense of dread. Through the windshield, a gray curtain of Pacific Northwest drizzle smears the highway lights, perfectly matching the storm that is forming over the housing market in this corner of the country. For years, you watched headline after headline praise Washington and Oregon as the safe havens of the American dream. Booming tech jobs, strong appreciation, a steady stream of Californians arriving with cash offers. But as you merge onto Interstate 5 and disappear into the gloom, the reality outside your window tells a very different story. The for sale signs you pass are fading in the rain, sitting in the same front yards week after week. Some are tilted, some are streaked with moss. The moving trucks you see in the breakdown lane are not unloading eager new residents. They are taking people out, taking their furniture, their savings, and their hopes along with them. On this episode of Discover the Nation, you and I are going on a difficult road trip through 10 Pacific Northwest cities where the American dream is actively turning into a financial nightmare. From a high-desert boomtown watching its bubble burst in real time, to a coastal metro where policy failures and crime concerns are eroding property values, we are going to show you exactly where the smart money is quietly backing away. If you already own in these areas, or you're thinking about buying the dip, you might want to pause before you grab a falling knife. Before we reach the #1 city, the epicenter of a massive inventory glut, we have a lot of miles and a lot of hard numbers to cover. Tap subscribe and like this video so we can keep guiding you away from bad investments and toward better decisions. Now put the car in drive, turn on the wipers, and settle in. We are heading straight into the crash.
Number 10. Salem, Oregon. You drive south into the heart of the Willamette Valley, tires humming over wet pavement as the outline of Oregon's capital comes into view. On paper, Salem has always been the calm one, a government town, steady jobs, less drama. For a long time, people believed that meant immunity from big swings in housing. As you glide past the white dome of the state capitol and through quiet neighborhoods of ranch homes and modest cul-de-sacs, that old story starts to fall apart. This used to be the place you moved when Portland got too expensive. But the gap between the two has closed so fast that local incomes simply cannot support the prices left behind by the last frenzy. You see street after street of mid-century homes that would have sparked bidding wars only 2 years ago, now sitting with bright, price-reduced banners slapped across their listings. Recent reports from major portals like Redfin show that more than 1 in 3 homes on the market in Salem has already taken a price cut. That means a huge share of sellers are being forced to admit they overshot reality. Inventory is climbing too. Active listings are up by more than 20% compared with a year ago. That is not a gentle increase. That is a wave of supply in a market where buyers are pulling back. Days on market are stretching longer, up by more than 15%. What used to go under contract quickly now lingers waiting for an offer that fits today's higher mortgage payments. Investors have noticed. CoreLogic-style data shows investor purchases in and around Salem dropping sharply, down by well over 40%. When professional buyers retreat, it is a clear sign that the easy profit has evaporated. Even more troubling, foreclosure filings have ticked higher, up double digits in a single recent quarter. Those are not just numbers, those are households that locked in at the wrong time and can no longer keep up. As you roll out of town, the message is simple. Government paychecks and a quiet reputation are not enough to defy gravity. Salem is now fully exposed to a correcting market, and the reset is just beginning.
Number 9. Olympia, Washington. You cross the Columbia River, leave Oregon behind, and follow the interstate north to another capital city. This time you arrive in Olympia, framed by evergreen hills and a wide, calm stretch of water. At first glance, it feels peaceful. The stately dome of the Washington state capitol, sailboats bobbing in the distance, tree-lined streets. But you did not drive all this way to be fooled by scenery. During the pandemic and the remote work boom, Olympia became a pressure release valve for Seattle. Remote workers fled down the interstate, chasing more space and slightly lower prices while still staying close to Puget Sound. That sudden wave of demand launched prices to unsustainable levels. Now, the tide is going out. Return-to-office mandates are pulling workers back toward the big towers.
Tech layoffs are chewing through payrolls. The remote work premium that once justified Olympia's rapid appreciation has evaporated. Detailed listing data shows that more than half of homes sold here are now closing below the asking price. That is a majority of sellers walking away with less than they hoped for. Pending sales are down nearly 20% compared with last year. The pipeline of deals is drying up. Months of supply has climbed past 3 months of inventory, a clear sign that buyers have the leverage and sellers are competing for attention. New listings are still coming, up in the low double digits, which only adds fuel to the inventory fire. The average sale-to-list ratio has slipped to about 98%, wiping out the days of bidding wars and over-ask offers. Behind the scenes, early-stage mortgage delinquencies in Thurston County are creeping higher, up close to 10%. That is the kind of leading indicator that can turn into a wave of distressed listings if conditions worsen. By the time you merge back onto the highway, it is clear that Olympia is suffering a serious hangover now that the remote work party is over.
Number 8. Bend, Oregon. You leave the rain behind and climb east over the Cascades into the bright, dry air of Central Oregon. The pine trees thin out, the sky opens up, and soon you are dropping into Bend, the high desert town that became a legend during the work-from-anywhere era. You see paddleboards strapped to Subarus, breweries packed on summer nights, pristine bike trails and riverfront parks. It is easy to understand why remote workers from San Francisco and Seattle fell in love with this place. But as you roll past luxury condos and new West Side subdivisions, the energy feels different. Open house signs sit out front with no cars in the driveway. Builders' flags flap in the wind with no one walking through the model homes. During the pandemic, Bend was one of the hottest markets in the entire region. Now it is a textbook example of a Zoomtown bust. Recent numbers from major listing platforms show the median list price in Bend backing down from its peak, with a decline of roughly 6% from the top. Inventory, on the other hand, has exploded, sitting about 40% higher than this time last year. Homes that once received multiple offers within hours now linger for a median of around 55 days. That is a lifetime compared with the frenzy of 2 years ago. Around 8% of investment and second home properties sit vacant as short-term rental income falls short of expectations. When the nightly bookings dry up, carrying costs suddenly feel a lot heavier. Single-family building permits have dropped by roughly a quarter. Local builders see what is coming and are slamming on the brakes. Price per square foot has edged down several percent, quietly erasing gains for anyone who bought at the top. Most telling of all, aggressive price cuts are now attached to more than 40% of active listings. That is almost half the market openly admitting that yesterday's numbers do not work anymore. The high desert dream has not disappeared, but the boom is over. The dust is settling, and what is left behind is a wounded market trying to find a new floor. Number 7. Tacoma, Washington. You descend back toward the coast and head north until the skyline of Seattle's southern cousin comes into view. This is Tacoma, the city of destiny, a working port and blue-collar hub that has long lived in the shadow of its richer neighbor. For years, being the more affordable option was Tacoma's main advantage. People priced out of Seattle came here, accepted the commute, and pushed prices steadily higher. Now that arrangement is backfiring. Drive through neighborhoods near the port and the revitalized downtown, and you notice something that was rare not long ago. For sale signs that stay in place, listings that age, sellers who keep cutting and still do not move. Data from the Northwest Multiple Listing Service shows that active inventory in Tacoma has nearly doubled in a year, up close to 95%. That is a massive shock of supply in a market where demand is backing away. Closed sales are down more than 20%. Buyers are not chasing anymore, they're stepping back and letting sellers sweat. Median prices have slipped by roughly 5% from the peak. For owners who bought with minimal down payments at top dollar, that drop is enough to erase equity. Foreclosure starts in Pierce County are up in the mid-teens. That may not sound extreme at first, but it is a clear sign that more households are starting to struggle.
The typical mortgage payment now eats up more than 40% of the median income here, which is simply not sustainable. Cancellation rates on pending contracts have jumped into the mid-teens as deals fall apart under inspection or financing pressure. Even the rental market is softening, with vacancy rates creeping towards 6%. When both the buy side and the rent side weaken at the same time, the underlying support for prices is gone. Tacoma is catching a chill because Seattle has a fever, and the people who bought here at the very edge of their budgets are the ones at risk.
Number 6, Eugene, Oregon. You guide the car south through the Willamette Valley until the hills open up around you and the city of Eugene spreads along the river. This is a college town and regional hub, framed by forested ridges, farmland, and the interstate. On a clear afternoon, it looks laid back and comfortable, the kind of place where the University of Oregon, the hospital system, and local businesses quietly keep everything running. On the surface, it still feels calm. Underneath, the housing market is under strain. For years, Eugene was the so-called affordable alternative to Portland, a place where remote workers, retirees, and investors could still buy into the Pacific Northwest dream without big city prices. That surge of outside demand pushed values far beyond what many longtime residents ever expected. Now those prices are colliding with higher interest rates and slower wage growth, and the tension is showing. Drive through neighborhoods near campus or newer subdivisions on the edge of town, and you notice the pattern. More for sale signs, more homes with blinds closed, and grass just a little too long. Listings that once drew multiple offers in a weekend now sit for weeks. Local reports show months of inventory creeping toward 4, a clear signal that buyers, not sellers, hold the leverage. Median sale prices are edging down from the peak. The drop so far may only be a few percent, but direction matters. Sellers who grew used to instant appreciation are quietly cutting expectations. Closed sales have fallen, liquidity is thinning, and time on market is rising. In many parts of Eugene, a new listing can sit close to 2 months before a serious offer appears. Builders are pulling back as higher financing costs and weaker demand make new projects hard to justify. Affordability indexes show a majority of local households effectively priced out. Elevated prices and expensive borrowing push most families to the sidelines, leaving sellers to fight over a shrinking pool of qualified buyers. Signs of stress are creeping into the credit data. Loans in early distress run above the state average, and a growing share of sellers are trimming their asking prices to get any movement at all. In some snapshots, well over a third of active listings have already seen at least one reduction. Eugene is not a flashy tech hub or a speculative resort town. It is a working valley city that was supposed to be steady and predictable. That is exactly what makes its slide so important. When even places like this start to wobble, you know the pressure in the housing market is bigger than just the coasts.
Number 5. Spokane, Washington. You point the car northeast, cross the spine of the Cascades, and descend into the inland northwest until the Spokane River winds into view. Spokane, the informal capital of the Inland Empire, was one of the biggest winners of the pandemic migration wave. For a while, it felt like everyone tired of coastal politics, traffic, and prices decided this was the place to start over. That frenzy pushed home values to levels many longtime residents never imagined, turning modest houses into lottery tickets. Now the wind has shifted. Drive through the tree-lined streets of South Hill or the newer suburbs, and you see a market that feels stuck between 2 eras. The locals who were priced out still feel angry. The newcomers who bought at peak prices now feel trapped, watching online valuations tick down month after month. Recent Redfin data shows the number of homes for sale in Spokane up more than 35% year over year. That is a significant rise in supply without a matching rise in demand. Open houses that used to be packed now draw a trickle of cautious buyers who ask more questions and write fewer offers. Median sale prices have flattened and, after adjusting for inflation, are effectively drifting lower by several percent. Properties that once sold in single-digit days now sit for around 45 days on average, sometimes longer if they are in outlying areas or need work. Almost 40% of active listings have already taken a price cut. That is a sign of sellers chasing buyers down the ladder instead of leading the market. Single-family permits are down roughly 20% as builders pull back to avoid standing inventory and protect their balance sheets. Rental vacancy has nudged higher, forcing some small investors to shave rents or offer concessions just to keep units filled.
Inbound migration that once flooded this market has slowed dramatically, removing the main driver of the previous boom. The sale-to-list price ratio has dipped below 100%, confirming that the days of routinely paying above ask are gone. Spokane was one of the stars of the last cycle. Now it is learning just how quickly momentum can reverse, and how unforgiving that reversal can be for anyone who arrived late to the party.
Number 4. Gresham, Oregon. You turn back toward the coast and aim for the eastern edge of the Portland metro, stopping short of downtown in Gresham. This city grew up as a classic commuter suburb, offering cheaper homes and a short ride into the urban core. But today, Gresham is dealing with a complicated mix of affordability, safety concerns, and spillover effects from Portland itself. Drive down the main avenues and through residential streets, and you notice empty retail spaces, aging apartment complexes, and for sale signs that hang longer than they used to. The problems that have weighed on Portland, including homelessness and public safety issues, do not stop at the city line. Buyers are no longer just looking at price. They are asking hard questions about stability and long-term livability. Local data shows median days on market in Gresham pushing toward 50 days. Closed sales are down close to 20% from a year ago. Inventory is up by roughly a quarter, leaving far more homes competing for fewer active buyers. In Multnomah County, foreclosure filings have risen by around 10%. That is a clear sign that more households are starting to fall behind. Average sales prices have slipped by about 4%, and active listings are sitting at multi-year highs. It is not just a few isolated neighborhoods. The whole area is feeling the strain. Rental vacancy rates are above 6%, putting pressure on landlords and undercutting the investment case for smaller multifamily properties. In the last quarter, nearly half of all homes sold here closed below the asking price. That is a market where bargaining power has shifted away from sellers and where perception matters just as much as math. Gresham does not control its own narrative anymore. It is tied to the fate of the greater Portland region, and right now, that connection is dragging values down.
Number 3. Bellevue, Washington. You cross Lake Washington, the skyline of Seattle fading in the rearview mirror as the glass towers of Bellevue rise ahead of you. This is not orchard country. This is a polished tech satellite built on office parks, luxury condos, and stock-based paychecks. For years, Bellevue was the upgrade move for anyone who won the tech lottery. That is exactly why the squeeze here feels so sharp. Bellevue's affordability was never built on low prices. It was built on very high incomes, generous bonuses, and rock-bottom interest rates. When money was cheap and tech stocks were soaring, 6- and 7-figure home prices felt normal. Now those assumptions are breaking. As borrowing costs climbed and layoffs rippled through major employers, the whole equation started to crack. Recent market summaries show price growth in Bellevue stalling after years of aggressive gains, with values flattening out and beginning to slip in real, inflation-adjusted terms. Homes that would have sparked bidding wars in a weekend are now sitting. Active inventory has climbed noticeably, and months of supply has pushed into territory that looks more like a balanced to buyer's market than the tight conditions of a few years ago. Purchase mortgage applications are down significantly as high payments collide with even higher salaries. Many would-be buyers simply cannot justify the monthly cost anymore. The share of listings with price cuts has risen sharply. Sellers who anchored to peak valuations are being forced to walk expectations down, step by step, just to get traffic through the door. The sale-to-list price ratio has dipped below 100%, and homes closing above ask have become the exception instead of the rule. New listings keep coming as owners with stock-heavy compensation or stretched budgets decide to cash out or move to lower-cost markets, adding even more supply to a cooling pool of demand. In Bellevue, the issue is not a weak job base or a forgotten farm town. It is a high-flying, high-income market discovering that even the tech-rich have limits when rates rise and confidence falls. And when a place this expensive starts to wobble, the shock waves do not stay on one side of the lake.
Number 2. Portland, Oregon. You aim the car back toward the coast and cross one of Portland's steel bridges into the City of Roses. Not long ago, national media treated this place as a poster child for creative urban life, food, culture, and steady growth. Today, the drive-through downtown feels very different. You see tents and blue tarps clustered under overpasses, for lease signs and windows that once held busy cafes and shops. Blocks that used to buzz with office workers now feel half empty. The story in Portland is not just about interest rates. It is about lost confidence. High taxes, political friction, and public safety issues have pushed many high-income residents and businesses to rethink their future here. That shift in sentiment is showing up directly in the housing data. Regional multiple listing service reports show median sale prices in Portland down more than 5% year over year, a sizable loss of paper wealth in a short time. Active listings are up close to 30%. That is a big surge in available homes competing for a smaller group of motivated buyers. Average days on market now sit above 50, a dramatic change from the rapid turnover of previous years. Commercial vacancy rates downtown have climbed to record highs, which drags down demand and prices for nearby condos and mixed-use projects. Tax records indicate that Multnomah County has lost significant adjusted gross income to outmigration, measured in the billions of dollars. When that kind of money leaves, long-term demand for high-priced housing weakens. Foreclosure filings are up around 15%. Closed sales are down more than 20%. That combination of fewer deals, more inventory, and rising distress is a classic correction pattern. Roughly 40% of sellers are now offering concessions at closing, whether that means covering buyer costs, buying down rates, or cutting price. Portland is not just cooling, it is working through a deep reset, and there is no clear sign that the bottom has arrived.
Number 1. Seattle, Washington. For the last stretch of this trip, you drive north along Interstate 5 until the Space Needle and a forest of glass towers rise through the mist. This is Seattle, the engine of the Pacific Northwest and the home turf of giants like Amazon and Microsoft. For years, the story here sounded simple: endless tech growth, endless demand, endless appreciation. Now, that narrative is cracking. You pass construction cranes frozen mid-project. You see condos with lights off, floor after floor. You hear about whole teams laid off in a single email. The same tech sector that lifted Seattle's housing market to the stratosphere is now pulling the floor out from under it. Redfin data shows the median sale price in King County down close to 10% from its peak. For a typical buyer who's stretched to get into a seven-figure home, that is hundreds of thousands of dollars gone on paper. Year over year, inventory is up by more than 40% in some neighborhoods. The luxury segment is especially wounded, with high-end sales down over 30% as bonus packages shrink and stock grants lose value. Tech layoffs have hit tens of thousands of workers in the region, removing a huge pool of qualified buyers almost overnight. The share of homes selling above list price has collapsed from more than 70% at the height of the frenzy to less than 20% today. Rents are softening in many parts of the metro, making it harder to justify buying when the monthly cost of ownership is so much higher. Foreclosure starts are ticking higher, up in the low teens, especially where adjustable rate mortgages are resetting into a very different rate environment. Investor purchases have fallen by roughly half. The smart money that once treated Seattle as a guaranteed winner is sitting on the sidelines or moving elsewhere. You pull over at Cary Park and look out over the skyline through the drizzle. The trip is over, but the implications are not.